I want to welcome everyone back to another episode of Cam Harvey's Through the Noise. And I want to welcome anyone who is new to Cam Harvey's Through the Noise. I'm Robert Olinger. I'm Assistant Dean here at the Fuqua School of Business, and I'm with Cam Harvey, who is a Distinguished Professor of Finance here at the Fuqua School of Business. In our last discussion, we discussed a little bit about the Fed, and you had mentioned the rates are too high. And I thought it would be great for us to have a discussion about what does that mean? What do rates mean? And when you say something like that, what should we be hearing?
Yeah, so perhaps it was a little imprecise. What I was talking about with respect to the Fed was the short-term rate, the so-called Fed funds rate, which is really an important rate in the economy for short-term lending and borrowing. So that's a rate that's highly correlated with treasury bills and things like that. It turns out that a more important rate is the longer term rate. So the Fed has the maximum amount of control over short-term rates. So effectively they set the Fed funds rate. They have much more limited control over longer term rates. And the long-term rates are really important. So think of the longer-term rate, so 10-year and beyond. That's the rate that drives the mortgage rates, which is very important for the economy in terms of housing. That's also the rate that's crucial for corporations. So when they go out to borrow, they're borrowing generally a longer-term maturity. And this makes sense, because companies are evaluating investment projects, and those projects are not 90-day projects. Those projects are often multi-year projects, and what matters for them is the longer-term rate. So when the longer-term rate is high, that just means that there are fewer projects, investment projects, that are profitable. And as the financing becomes cheaper, more projects become viable. So it's the long rate that is crucial for the economy, and it is the short rate that the Fed has most influence over, not the long rate.
Then can we get into, then who controls this long-term rate, and where do you think, or where are they going these days?
Yeah, so there's nobody that controls this rate. So there are many influences on the rate. And let me maybe give my view as to what will happen in 2026. So I generally believe that there's more upward pressure on long-term rates than downward pressure. And let me go through a few reasons. So number one, we've talked about already that we've got $38.1 trillion of debt. And about a third of that debt will roll over in 2026. And when you flood the market with new financing, it means that prices generally go down, which means rates go up. So just the size of the refinancing, the fact that the deficit appears to be not under control, this is something that would exert kind of an upward pressure on long-term rates. So number two is something that's been playing out for the last couple of years, and that is this idea of de-dollarization. So a number of countries want to reduce their dependence on the US dollar. And what that means is reducing their holdings of US assets and substituting something else. That's really interesting. There's a recent report that shows that central banks are holding more gold now than US dollar assets.
So is that the something else?
Yeah, so this is something that will continue. And this means less demand. So fewer buyers for US Treasury bonds. And again, when there's fewer buyers, the price goes down, which means the rate goes up. Number three is also playing out in real time, that there is a pressure to deglobalize, which means less trade. So given what we've seen with tariffs, less trade, that means perhaps a smaller trade deficit for the U.S. And remember, with a trade deficit, that means some country ends up with U.S. dollars. And they don't hold cash. They usually buy U.S. assets like treasury bonds. Well, if there's less U.S. dollars floating around, that means less demand and, again, higher rates.
Is it okay if I kind of repeat where we've gotten to right
Sure.
now? So you talked about we have a bunch of bonds that are going to roll over with the Fed. We have countries that are not going to purchase as many of those, and they're purchasing gold and other assets in response. And then we also have a lowering of trade, which also reduces the demand for dollar assets. Is that about right?
That's all right. And I would probably add to that list that the U.S. has just become riskier. So they lost their AAA status, and you've got stuff going on that people are questioning, such as the tariff policy or the independence of the Fed. And it just makes sense for many countries to diversify, to hold something other than U.S. Treasury bonds. So all of that leads to kind of an upward pressure on rates, but it doesn't end there. So just recently in the news, we've got inflation that appears to be stuck in the upper 2% range, which is above the Fed target of 2%. So inflation is expected to be higher than the Fed target. And we know that rates are a combination of expected inflation and expected real rates. Mm-hmm. So that's another force, given that inflation is expected to be higher. And then there are structural things going on that I think are important. So we've talked about AI previously, and AI to me, people talk about increases in productivity, which is really important. But another major force is AI leading to deglobalization. And what I mean by that is that with AI and robotics, you don't need to trade with a country that's got really cheap labor. Mm-hmm. More specifically, think about, let's say, clothing being manufactured in Vietnam. Well, you can onshore the manufacturing of clothing, and you're employing humanoid robots that are working 24/7 at $1 an hour, no vacation. So I see a kind of a structural change from AI leading to a deglobalization. It'll be very good for the winning countries, like the U.S. Is likely a winner, but certain emerging markets that have their competitive edge with cheap labor will be losers. Again, with this onshoring, there's just fewer U.S. dollars floating around outside the U.S. And again, people don't hold cash. They buy treasury bonds. So there's another force, again, that is linked to AI that's under the radar. And that is the construction of data centers. And those centers are being financed by corporate debt. And a massive amount of investment-grade debt will be offered in 2026, a surprisingly large amount. And again, when there's a very large amount of debt put on the market, prices go down, rates go up. That's yet another force. The last thing I'll mention is important. And we usually think of rates, as I said, as expected inflation and then a real component. That real component is very much linked to economic growth. Mm-hmm. And I'm of the opinion that growth will be higher than expected over the next few years. And that growth, think of it as When there's more growth, you're competing for the resources. And this means that there will be more investment projects and more need to finance these projects, and rates will likely go up.